Imagine opening up a company's earnings report and seeing a book value of negative $45.58 per share.
Right. Which is just wild to even think about.
It's completely wild.
Yeah.
By all traditional accounting metric, I mean, the enterprise is totally underwater.
Oh, yeah.
It looks like a textbook liquidation candidate where the liabilities have just totally eclipsed the assets.
Right. Like, why are the doors even still open?
Exactly. Yet Wall Street is not only trading the stock, but institutional investors are like actively hunting for a turnaround here.
Mm-hmm.
So welcome to the deep dive. I know on Talk Tickers, we usually try to keep our mission to under 5 minutes and just hit the takeaways, but
this one's a little too messy for 5 minutes.
Yeah, it's way too complex.
Yeah.
So today we are doing a massive deep dive into the Q2 2026 earnings call of MBIA Inc.
Ticker symbol MBI.
Ticker MBI, right. We're going to decode the management commentary, the analyst Q&A, and the raw balance sheet data to figure out if this municipal bond insurer is a classic value trap or maybe one of the most asymmetric special situations plays in the entire market.
And we definitely need the time today because municipal bond insurance is traditionally a pretty sleepy sector, right?
Yeah, incredibly sleepy.
Yeah. Usually it's just clip the coupon, collect the premium, and go home.
Right. But right now, this stock is anything but sleepy.
No, it is heavily embroiled in some really high-stakes, distressed debt litigation.
So let's just get right into it. Why don't you rip into those headline numbers for us? Because they require some immediate translation.
Yeah, they really do, because they kind of look contradictory on their face. So MBIA reported a consolidated GAAP net loss of $46 million, which translates to negative 91 cents per share.
Ouch.
Right. A loss is never the goal, obviously, but the trajectory actually shows a slight improvement from the $56 million loss in the same quarter last year.
Okay, so they're losing slightly less money.
Exactly. And if you strip out the accounting noise and you look at adjusted net loss, the company's sitting at a negative $7 million.
Oh, okay.
Yeah, which is negative 14 cents per share.
That's a huge difference from $46 million.
Right, it is. But honestly, the true focal point for anybody screening this stock, the thing that jumps off the page, is that book value.
The negative $45.58.
Yes.
Yeah.
That's staggering negative 45.58 per share as of June 30th. And it's heavily driven by one specific subsidiary.
Which one is that?
It's MBIA Insurance Corp. That subsidiary single-handedly drags the overall metric down by a massive $54.26 per share.
Wait, I have to stop you there because treating a negative $45 book value as just another data point kind of ignores the mechanical reality of what that means.
Sure, yeah.
I mean, for a shareholder, if GAAP accounting dictates that the company owes substantially more than it owns, why on earth is the market just ignoring the insolvency?
Well, the market isn't exactly ignoring the insolvency. It's more that they are recognizing that GAAP accounting is just fundamentally the wrong tool for measuring an insurance company's immediate viability.
How so?
So GAAP requires a company to mark its long-term liabilities to market right.
Okay.
It forces them to factor in these theoretical long-tail losses as if the company were forced to liquidate its entire portfolio today.
Oh, I see. So it's pricing in worst-case scenarios for decades down the line all at once.
Exactly. But insurance regulators don't evaluate solvency using GAAP. They just don't.
What do they use instead?
They use statutory capital accounting.
Okay, so let me see if I have an analogy for this. This is sort of like looking at a house where the mortgage is substantially larger than the appraisal value.
Right.
Like your GAAP net worth, based on the daily fluctuating Zillow estimate of your house, says you're bankrupt, even though you have no intention of selling the house today.
That is a perfect analogy, yes.
And the statutory accounting would be like just checking your actual bank account to ensure you have enough cash to pay the mortgage this coming Friday.
That is the exact mechanism at play here. Regulators care about the vault.
Right.
They care about statutory capital, which calculates the capital and surplus that is available to pay claims right now today.
Got it. So what is in their vault right now?
When we look at MBIA's actual liquidity, the holding company is sitting on $337 million in unencumbered cash and liquid assets.
Wait, $337 million in pure liquidity.
Unencumbered cash and liquid assets, yes.
Okay, but $337 million in unencumbered cash doesn't just exist in a vacuum.
No, definitely not.
Because management noted on the call that number is actually down from $357 million at the end of last year.
That's right.
So we are looking at a $20 million cash burn over just 6 months from ongoing debt service and operating expenses.
Yeah, they are definitely burning cash.
Right. And if the core business is bleeding cash, while holding guaranteed investment agreements that require collateralization, which management also noted accounts for another $183 million in pledged assets. That $337 million is a finite runway. It is not a permanent safety net.
No, you're totally right. And that burn rate is precisely why the timeline of their legacy liabilities dictates this entire investment thesis.
Because they can't just wait forever.
Exactly. MBIA is essentially in runoff mode right now.
Explain what runoff mode means for the listeners who might not know.
Yeah, so runoff mode basically means they aren't writing new business. They aren't going out and insuring new municipal bonds.
Okay.
They're just managing the slow unwinding of their massive legacy insurance portfolio, just paying out claims as they come and trying to manage the assets they have left.
Just managing the slow decline, basically.
Right. And the single largest threat to that $337 million lifeline, the real bottleneck holding the entire corporate structure hostage, is located in Puerto Rico.
Yes. We are talking about the PREPA saga.
The PREPA saga, exactly.
The Puerto Rico Electric Power Authority.
Right.
This is the story behind the numbers. The data from the earnings call shows that MBIA's subsidiary National Public Finance Guarantee Corporation has managed to reduce its gross par PREPA exposure down to $390 million.
Which is still a huge number, but it's down.
Right. They mentioned they actually paid out $35 million in claims on bonds that matured just this past July to get the exposure down to that level.
Yeah, and that $390 million in remaining gross par exposure is the entire catalyst for the standoff that is currently paralyzing the stock.
It's the big elephant in the room.
It really is. And to understand the friction here, we have to look at the mechanics of the restructuring negotiation.
Okay, lay it out for us.
So you have the entity managing Puerto Rico's bankruptcy, which is the Oversight Board.
Right, the FOMB.
Exactly. And they recently presented a new settlement offer to the bondholders. They actually escalated their initial offer of $1.6 billion to approximately $3 billion.
Wow, so they nearly doubled it.
They did.
On paper, an entity doubling its settlement offers signals a pretty massive concession.
You would think so, yeah.
Right, like if the Oversight Board is willing to move from 1.6 to 3 billion, the logical assumption is that a deal is imminent. They're getting closer.
It sounds like a breakthrough.
But bondholders representing 90% of the claims just outright rejected it.
Soundly rejected it.
Yeah, CEO William Fallon noted on the call that the coalition found the offer completely unacceptable.
And that rejection makes perfect sense when you actually price the gap between what the offer is and what the open market is doing.
Okay. Break that math down for us.
So Fallon explicitly pointed out the math on the call. The Oversight Board's $3 billion offer translates to a recovery rate of roughly 30 to 40 cents on the dollar for the bondholders.
Okay, so they're taking a massive haircut.
A huge haircut. But in contrast, those exact same pre-PA bonds are currently changing hands in the open market at approximately 75 cents on the dollar.
Wow. Okay, so the market is pricing them at 75, but the offer is only 30 to 40. This is the disconnect that I just find so fascinating. I mean, essentially, MBIA and the bondholders are playing a massive game of chicken with the Oversight Board over a 35-cent spread.
A very expensive game of chicken.
Right. But I struggle to understand the leverage that the bondholders think they have here. Okay. I mean, if the Oversight Board holds the keys to the restructuring, why wouldn't the bondholder coalition take the 40 cents rather than risk a court wiping them out entirely?
Because the bondholders genuinely believe the structural protections of municipal revenue bonds insulate them from a total wipeout.
Okay, explain the difference there for us. What is a revenue bond?
So revenue bonds historically are backed by the specific cash flows of a utility. So in this case, it's electricity payments from the citizens of Puerto Rico.
Oh, right.
It's not backed by the general tax base of the municipality like a general obligation bond would be.
So as long as people are paying their electric bills, the revenue is there to pay the bonds.
That's the argument. The bondholders are looking at the utility's ability to generate revenue, and they are arguing that PREPA is fully capable of honoring a much higher percentage of its debt than the Oversight Board claims.
Interesting.
Yeah, and that 75-cent open market price reflects institutional confidence that the legal system will ultimately uphold those historical revenue bond protections.
But that confidence introduces a really significant layer of political risk.
Oh, absolutely it does.
And this actually became a pretty big focal point during the analyst Q&A on the call.
Yeah, that was a really interesting exchange.
It was. One analyst specifically pressed management on the risk of what he described as blue states or socialist groups choosing to just not honor existing financial contracts.
Right.
The underlying fear from the analyst was that political rhetoric could somehow just override legal financial obligations.
Yeah, assessing political risk is basically mandatory in municipal finance, but the methodology really matters here. Well, how a management team quantifies political rhetoric really separates the serious underwriters from the speculative traders.
I thought CEO William Fallon's response to that was highly data-driven and very impartial.
Very impartial.
He acknowledged that MBIA incorporates the political trends of different administrations into their portfolio analysis, of course.
As they should.
But the critical data point he delivered was that MBIA has not taken any specific impairments this quarter related to administrations choosing to ignore contractual obligations.
Right. He essentially detached the company from the political theater entirely.
Just stuck to the numbers.
Exactly. I mean, monitoring local government trends is standard risk management.
Yeah.
But until a municipality actually defaults on a payment due to a political decision, an insurer cannot arbitrarily write down the value of their portfolio based on press conferences.
No, that would be chaos.
It would. Management expects the obligations to be fulfilled, and the balance sheet reflects that expectation, not the analyst's hypothetical fears.
Which brings us to the operational reality then. If management is ignoring the political noise and relying on the legal system to enforce prepay's obligations, what is the actual timeline here?
Yeah, the timeline is key, and according to the guidance provided on the call, the litigation has shifted into a much more aggressive gear recently.
Widely.
Yeah, Judge Swain recently lifted a litigation stay, which is pushing the battle over how prepay calculates its net revenue directly into the discovery phase.
And discovery is where things get real.
It's the mechanism that forces both sides to open their books completely.
Right, so the bondholders want to prove that prepay generates enough revenue to pay closer to 75 cents on the dollar.
Exactly.
And the Oversight Board is attempting to prove the utility can only sustain the 30 cents.
You've got it. And concurrently, management noted that oral arguments are actually scheduled in Boston for September 15th, 2026.
Okay, so we have a hard date.
We do. That's regarding administrative claims in the First Circuit Court of Appeals.
But the legal friction extends beyond just the revenue calculations, doesn't it?
Oh yeah, it gets much more complicated.
Because CEO Fallon highlighted a pretty severe structural uncertainty regarding the Oversight Board itself.
Right, the actual makeup of the board.
Yeah, he mentioned there are currently only 4 active members on the board, and 3 of them are actively litigating against their dismissal by the previous presidential administration.
Which is just a wild situation for a negotiating partner to be in.
Completely wild. The White House Personnel Office is attempting to remand that case back to trial court. So MBIA is negotiating a multi-billion-dollar settlement with a board that might not even be legally constituted to finalize the deal.
And that institutional paralysis of the Oversight Board perfectly explains why management is hoarding cash right now.
Oh, that makes sense.
If the counterparty is tied up in Supreme Court and appellate litigation over its own existence, a quick settlement is just completely off the table.
Right. They're bracing for a long winter.
Exactly. This is why the debt service relief schedule is probably the most important forward-looking metric for the holding company's survival right now.
Well, let's talk about that schedule, because management outlined that pre-PA payment schedules drop significantly in the coming years.
They do. They drop to just $20 million in 2027 and remain at $20 million in 2028.
Which is huge, because they just paid out $35 million in a single day this past July.
Right.
So throttling those obligations down to just $20 million annually provides massive relief to that $337 million liquidity cushion we talked about earlier.
It fundamentally changes the burn rate calculus for them.
Yeah, gives them breathing room.
It extends MBIA's runway, allowing them to basically wait out the appellate courts without being forced into a sudden liquidity crisis.
But that extended runway also creates some pretty immediate friction with retail investors.
Oh, definitely.
Because investors want to see capital deployed now, right? They don't want to see it hoarded for a legal war of attrition.
And we saw that tension play out live on the call.
Yes, we did.
The tension over capital allocation was probably the most volatile moment of the whole earnings call.
It was fascinating to listen to. An investor basically called in and pointed out that MBIA has $71 million in remaining share buyback capacity under their current board authorization.
Right. It's just sitting there approved.
Just sitting there. And with the stock price suppressed to around $5, he practically begged management to execute the trades.
Because the math is so compelling at $5.
Exactly. He noted they could retire roughly 14 million shares immediately with that 71 million.
Which is a huge chunk of the float.
And management confirmed, right? the capacity is fully available.
Yeah, they confirmed it's there. There are no legal or regulatory constraints preventing them from buying back stock tomorrow if they wanted to.
And honestly, the investor's logic is totally sound.
Yeah.
I mean, if management truly believes that the GAAP book value is just an accounting fiction and that their statutory capital is sufficient, buying back stock at $5 is easily the most accretive move they could make for long-term shareholders.
You're right. The mathematics of the buyback are incredibly accretive.
Right.
But the risk management side of it is potentially catastrophic.
Okay, walk me through that.
If management drains $71 million from their unencumbered liquidity, they forfeit their primary leverage against the Oversight Board.
Oh, because they lose their runway.
Exactly. A distressed debt negotiation of this magnitude is a siege.
Yeah.
And the side that runs out of cash first is forced to capitulate.
Wow, that makes perfect sense.
Yeah.
They need that war chest to prove they can wait as long as it takes.
Right. And Fallon's noncommittal response to that investor, he simply acknowledged the enthusiasm but didn't promise anything.
Yeah.
It really demonstrates that management is prioritizing corporate survival over short-term stock price manipulation.
Survival is definitely the prerequisite here. But an outright sale of the company seems to be the ultimate catalyst everybody is waiting for.
Oh, yeah. M&A is the end game here.
Because another analyst brought up the halted public sale process that MBIA previously ran with Barclays.
Right. They tried to sell themselves a while ago.
Right. And the analyst asked if management was considering initiating another formal search for a buyer now.
And Fallon delivered what I think is the most critical, forward-looking statement of the entire call in response to that specific question.
What did he say?
He stated, and I quote, "The probability of a transaction goes up every time we reduce our exposure to PREPA."
Wow. Tying the M&A catalyst directly to the prepaid paydown is a massive signal.
It's practically a flashing neon sign.
Right. Management isn't currently running a public sale process right now, but they are aggressively telegraphing that the company is on the market the very moment that Puerto Rican liability is finally quantified.
Because potential acquirers are out there modeling this exact same data.
Sure they are.
A larger financial institution is not going to step in and buy MBIA while that $390 million prepay exposure remains an unquantifiable black box that's subject to First Circuit litigation.
It's too much unknown risk.
Way too much.
Yeah.
But the second that exposure is settled, whether it's at 30 cents, 75 cents, or somewhere in between, the risk is formally capped.
And once the risk is capped, an acquirer can accurately price MBIA's legacy portfolio and its $337 million in cash.
Precisely. They can finally put a real floor on the valuation.
So this brings us right to the bottom line. We have dissected the negative book value, the statutory capital lifeline, the prepay litigation bottleneck, and the M&A catalyst. What is the actionable takeaway for an investor looking at this stock today?
Well, the data dictates a very polarizing verdict.
Okay, give it to us.
MBIA is structurally bearish for traditional value investors. Let's just be clear about that.
Right, it's not a widows and orphans stock.
Not at all. If your portfolio requires clean GAAP profitability, steady dividend growth, and a pristine balance sheet, this company fails every single metric.
Miserably.
Yeah, they are actively burning cash on operations, posting GAAP losses, and fighting a multi-front legal battle against a government oversight board.
To stay away if you want safety.
Exactly.
But the flip side of that verdict has to be a conditionally bullish setup for high-risk tolerance investors who are hunting for special situations.
Precisely. The entire investment thesis here rests on the delta between the Oversight Board's 30-cent offer and the market's 75-cent reality.
All about that spread.
A prepay resolution is the master key. If the bondholders win in court and force a settlement closer to the historical recovery rates of revenue bonds, it immediately unlocks the stock.
Because the uncertainty vanishes.
Right. It preserves the holding company liquidity. It puts that $71 million buyback authorization immediately into play, and it lights the beacon for a corporate buyout.
It all comes back to a pricing anomaly that I honestly want to leave the listener to mull over on their own today.
It's a great puzzle to end on.
It really is. Think about this. We have two highly sophisticated markets looking at the exact same legal documents, the exact same utility revenues, and the exact same appellate court dockets.
Yeah, all the same public info.
The municipal bond market is confidently trading prepaid debt at 75 cents on the dollar, implying a massive legal victory for the bondholders. Meanwhile, the equity market has battered MBIA stock down to $5, terrified a 30-cent settlement at a negative GAAP book value.
It's totally, completely bifurcated.
One market is pricing in a structural win based on legal precedent. The other is pricing in a catastrophic failure based on accounting technicalities and political fear. They cannot both be right.
No one of them is going to lose a lot of money.
So the question you have to answer before even touching this stock is, which market has fundamentally mispriced the reality of the courtroom?
That is the multi-million-dollar question.
Thank you for joining us on this deep dive into MBIA. Keep dissecting the data, keep challenging the consensus, and we will see you on the next Talk Tickers.